what options does let's say the founder have here? Hello.
Yeah, I'm with you. Sorry.
Yeah. What options the founders have here?
Um, uh, Early thoughts. Obviously, one is creating that secondary option, either buying out angels themselves or talking to Cougar or Friendly and asking them to increase or reach the target percentage through a secondary with angels. That is one option.
Okay.
Right. And what else? So a partial secondary would lead to maybe a 4% or so increase though. And
Yeah, so I think if you do a partial secondary, you will have to first figure out secondary goes to whom. If it's at a discount, right? The secondary has to be split between both the people at Friendly Ventures who are doing pro rata and the incoming investor, right? Both will get secondary, isn't it?
Yes.
And okay. What is the other option, other lever? Can we push and do a scenario of like 110 million pre?
110.
120. Anybody has any view here? What is like worth looking at? So one axis is how much secondary is available, right? So you will do scenarios on the basis of these numbers given here and blend in how much secondary is available. You probably assume a 10%, 20% discount. Let's say 10% discount to the secondary for buying, right? Okay. So that is one form of one scenario. The other scenario is, can you push the valuation a little up, right? Now, if you are a founder or an analyst helping the founder, how will you find out what would be an acceptable equity ownership for Cougar Ventures? How will you go about it? Anybody else who wants to take a shot? How will you find out that, okay, Cougar has given this term sheet, they're asking for 20% or 25 million, but maybe they are okay for 15, they're okay for 16, they're okay for 18. How will you find out?
So just from a perspective of the founders, right? They've got 60%. Presuming a 100 pre-K round, they're looking at about a 20% dilution, which is 12, and then pro rata Friendly would do another 4.5%. So that's a 16.5. They can afford to lose a max of 10%. So that's about a gap of 6.5 they want to fill in, right? So they might want to push.
Not that. That's not my point. That's my point. The question is, you want to negotiate with Cougar Ventures here, right? And you want to push them to saying you must take less equity. How do I build that case? How do I collect data? You don't want to take too much panga whether the deal may or may not happen, right? So how do you find out what is acceptable ownership for them? If it is not 20, will they be okay with 18? Will they be okay with 17? How do you find that out? Because that's how you'll push for a increase in valuation, isn't it? Anybody else has a view? How do you find out what will be acceptable range? You'll probably talk to some other founders who have gone through a similar negotiation with Cougar Ventures, right? You'll talk to a few other VCs to find out what exactly is the holding of Cougar in their cap table. Right? Will that be useful?
So probably also figure out the fund dynamics of Cougar. What's the size? Let's say they're a $500 million fund, right? So they need this check to at least 20x.
It depends, right? Cougar is another. It's like a feline species, right? It's a cat species only. So those funds don't have ownership issues. Ownership issues were lesser mortals. People who do few deals, people who do like one deal a day, they don't have ownership issues. Normally not, right? So I think you should prepare some scenarios and present so the idea would be to put founder at 51%, not even 50 or 50.1, 51%, and then try to squeeze in various things by increasing the valuation, by selling part angel equity, and worst case by also reducing the ESOP, right? Because there is also a possibility that Cougar, while I have not mentioned here, people might say that you re-up the ESOP pool to 10, whereas the founder can say, can I reduce the ESOP pool a little bit? Uh, Tough
So
one to
that
do,
is an
but
option.
it can be. Everything is an option. If you
Okay.
the founder and somebody wants to negotiate, you could say, okay, the ESOP will post dilution will become 8% or whatever. Can we bring it down to 7, for example? Uh, all these are possibilities. I'm not saying it's real, but theoretically, yes, it's possible. So, okay, guys, what do you expect from this exercise? Like anybody who doesn't know this at all, if people know this, then I can go back to exercise 1. Anybody who can't do this, prepare scenarios, find this a little difficult.
So to be honest, I have not done this before.
No, you've not done this. Is it complex or is it easy?
It
Anybody who
is.
thinks it like will be worth going through this here right now? This
I think
particular calculation. Guys, somebody will have to speak up, because unless if I see 3-4 people saying yes, let's do it, I'm not going ahead, because then we can go to exercise 1. Okay, somebody is writing in chat. Yeah, Vastal, we hear you. Ashita is saying agreed, which means what, Ashita?
No, I mean, you should discuss it because even
Okay,
I have
okay.
limited
I thought you were
knowledge.
agreeing with me ki unless 3 people say
No,
yes, it
I
means
was
okay.
agreeing with Vatsal.
Okay, okay. So Satvik is also there. Okay. Satvik is writing this just to make sure that 3 is achieved and we move forward. Okay, guys. Okay, guys. So this is sort of where we are. Let me just hide this also. Now, what is the typical number of companies, number of shares in a fresh company in India? Anybody
Anand,
knows?
you have to share your entire screen, I think.
Oh, you can't see my screen. Sorry. Okay.
10,000.
10,000 shares. Why is that?
10,000 into 10 rupees, 1 lakh is the minimum you have to do as paid up capital, I think, to do a
Good
private
point.
limited.
That's the minimum form of a company. So I'm assuming that the company started with the founders only 10,000 shares here. Okay. You can actually get the numbers from the actual company also, right? Whatever the number was, right? Everybody's with me on this?
Yes.
So what I did was, the founders owned today 60%. They originally had 10,000 shares. Okay. So 100% will be what? 100% will be 10,000 divided by 60% into 100%. Okay. So this is how I arrived at the total number of shares in the company. Everybody with me? So this is a good time to ask a question. Guys, even if you're okay, tell me you're okay.
Yeah, clear to me.
This is clear.
Okay, this is clear. Good. So now that we know the total number of shares in the company, because 60% is equal to 10,000, 100% is 16,000 something. We find out the number of shares owned by the angels and ESOP and other people. Okay, is that fine? Right?
Okay.
This is easy. Now we'll try to do the first step. We'll not try to calculate everything. We'll try to do the first step here. The first step would be, okay. Let me just hide this so that it doesn't confuse me. More importantly, the first step would be that what happens when Cougar Ventures takes 20% equity. Okay, they take 20% equity. We dilute everybody by 20%, so 60 becomes 48. The number of shares they'll hold. They're not selling anything. They'll hold the same number of shares. 60 will become 48. Angels and all will go low, and somebody will come with 20%. Now, if this was true, this guy will get this much number of shares, but Friendly Ventures goes down to 18%, right? Friendly Ventures needs to be brought back to 22. Okay. So this is the problem when you start just do this first step. Dilution will cause Friendly to go down from 22 to 18. They have to be brought back to 22 because they have said that they will do full pro rata. So in the next step, you do the full pro rata of these guys, right? So from 22, you bring them back to 22%. Now this will mean that from the previous scenario where there's no pro rata, from this scenario, the number of shares of both will increase, right? Friendly wedges also will increase, and this will also increase. You want to look at the formula, how I arrived at this?
Yeah.
Yeah.
Yes, please.
Okay. So what I did here was I made sure first that these people have constant number of shares, right? Now, if this is 22, this is 20, these two numbers are frozen. Okay. This is how much? This is 42%, right? These two, if you see my screen. Friendly
Yes.
Ventures, Cougar Ventures are static. The other guys are reducing from their original 60, 80, whatever. They are reducing their position, okay, to reducing the position to wherever they are now. So they have to go down to make room for this 42. Originally, they were at 68, 10. This 22 remains 22. And this 68, etc. They will sort of go down, right? So I compressed this 45%. What I did was I did 1 minus this 20 and 22 is 42. Okay. And I said from 60, what is the proportionate loss that this guy will have? So the founders give away 15%, the angels give 2%, the ESOP guys give 3%. 15, 2, and 3 will be how much? 20%. So the entire 20% for Cougar is coming from these three people. That's the math we've done. Got it? Okay. So now I modify the percentages. Now we have a new equation. This guy is at 45% with 10,000 shares, right? If that is the case, what would be the total number of shares? Okay, so I will get a total number of shares and then I can apply this to everybody. That is one way of doing it, or you can do it whichever way. But you got two anchoring numbers. Founders who had 10% equity need to go down to 45%. That will give you the numbers of the entire shareholding. Everybody with me? If you guys want to, like, see, this is important. If you guys want to open a spreadsheet and do it for yourself, it'll be better. If you can reach here, everybody can open a spreadsheet, reach here, it'll be good. So that, if you, I mean, there is no better way to learn a spreadsheet than to just start typing, and start tracking and making formulas. Give me 1 minute. Guys, are we there?
Yes.
Okay. Now I haven't solved anything beyond this. Now, what should be the first move for us? Anyone? What should be the next adjustment to do here? I need to find
The founders'
out.
equity.
Founders equity is 45, right? It needs to go to 50.
Yeah.
So what are the levers I have, right? The levers I have are, one lever is that I can increase the valuation and hence reduce this 20% to a little lower. That is one lever, which doesn't look like, because 5% मुझे देना है. I can't reduce this that much, right? Google will not accept probably. So let me first solve for the one more possible thing, which is like angels selling everything, right? Okay, makes sense.
Yeah.
So angels sell, right? Now every math will change, yeah, by the way, here. So now this number will remain constant, okay? Because this is what you arrived if angels are not selling and if the whole deal goes through with pro rata happening. So let's take this number. Let us paste this number as a, what do you call, like, there's a special paste which you make here. I paste these numbers. Oh, sorry.
I think you're looking to do Command Shift V.
Command Shift V.
No,
Let
do
me just
paste as
copy
values.
this.
Copy this and do paste as values.
Yeah, that's what I'm trying to do. Paste special
Value.
paste
Yeah.
नीचे आ गया bottom में. एकदम last.
values. Yeah, perfect, right? So this is what I'm looking to do, right? So these numbers will not change. Now, what will happen is that, if this 6 goes to Cougar entirely, okay. Let's assume right now there's no discount. We can also simplify it, assuming that the entire equity is going to only Cougar. The new dilution will be 13%, right? Or something like that, but it won't be 13. So we'll have to sort of do a little bit of what do you call? How will we arrive this number? We'll have to do a little bit of touch and go, right? So what I will do is I will do a teacher here total angel plus Cougar. Okay. And I will try to say this angel, this is Cougar plus angel, which is 26%. This total can be 20% because that's what they've asked for, right? So I will try reducing these numbers. Okay. Now this number we've taken 25 at 125, which is 20%. Let's say I reduce this to $17 million and on 117. And this is important to do this trial and error. There are other methods. I just not doing this method wise. I'll tell you separately. I'll give you a spreadsheet separately. So this is sort of 21%. This is sort of in the range, right? What should we do here? Reduce a little bit. Make it 16, maybe 15. Maybe 15. Let's see what happens with 15. 20%. Let's see if it's like good for some more decimals. Okay. 19.71. So 15.5. Right? This friendly still remains as per our formula remains at 22. It has to be okay. And this total of Cougar and Angel is now 20%. This is what we need now, right? So what I will do is I'll scrap this. I will make this 0 in the next slide. Okay, so this share table. These shares are what they were in the previous number. This is the dilution now. We have achieved 50%. Let's see if it is like, no, this is 50. Okay, this is 49.7. We need to, oh, this is 49.7. Will the founders accept this?
No.
Maybe they will, maybe they won't. No? Maybe they won't. Maybe you can ask friendly to reduce MSOP a little bit. Okay, the proportionate rate a little bit, go down to maybe 21%. We'll see that later. For now, let's see what the math leads to, right? So here what we're going to do is all these 1,333 shares of angels, all of this will be added to these people, right? So these guys will have this much plus these many shares in the previous sheet, and this will go to 0. Okay, this will go to 0. And now if we see the total, this is still the same number. Okay, the angels have become 0. Their shares have been added to this number here. So this is the shareholding now of, now if I calculate the shareholding by a simple division, this is 20%. Okay, fair enough.
Yes.
Everybody here with me, right? Now of course, what are the methods now? How do you make the founders go the last mile? Because Cougar will not accept. We don't have angel shares anymore left. What do we do? We can ask friendly to reduce, right? A little bit. Purita, what do you think?
And yeah, I mean, though chances are they won't. They will try. I mean, they are a significant minority.
Anybody? There is a big problem here, actually. By the way, anybody see what? Yeah, Aman is right. Angels may want a part exit. But there is another problem. We have not put a constraint here. And I thought of the constraint, I'll skip it. What is the major change in this formula? Formula तो meet हो गया. मान लो कि 50% है. Let's say, okay. And let's say angels are selling. Let's say everything is set. Will the deal go through? Is it the right deal for the company? What is being missed here?
Isn't he supposed to raise 23 million?
25.
Good
25,
point,
sorry.
Ashita. Good point. He's supposed to raise some amount of money, right? So he was supposed to raise 25. He may be okay with 20, maybe, if he doesn't want to dilute, right? But he's right now raising how much? Now can
15.
anybody do the math of how much he's raising? No, not 15. He's raising more. 15 is being put by Cougar. Friendly also putting some money, no? How much is Friendly putting? Anybody can do math separately and tell me how much Friendly is putting? Hello?
That should be the incremental number of shares into the value per share for the round that Cougar is coming in. Like,
good. So what we will do is good idea. The total amount Cougar's investment is how much? 15.5, right? 5 million. What is the 15.5 million? So this should be 15.
They are putting 4.5.
Good in counting zeros.
They are putting 4.4 million.
Sorry?
Yeah, 4.37 roughly.
Yeah, they are
4.4 million for X number of shares. Right. So 15,000. So let's say 15.5 million here. 15.5 million here. And Friendly is putting 4.4 million. Okay, total is sort of 20 million. Is it okay? Or a little less? What would you advise everybody to do now? Here. This is sort of 20 million. This is sort of acceptable, not acceptable. What do you think? What else is possible here? What other lever is possible here? We talked about a higher valuation also, right? Do you think it's possible to make it a slightly higher valuation? You can ask for it, right?
You actually reduced the post money, right? You kept the pre-money the same, but you reduced the post money. We can increase the pre-money, like you said.
We can increase the pre-money a little bit more to make it like what?
130
Make
post.
it 110. Huh?
That's the post money, right? 115.
115 is the post money right now. Oh, 115 is the post money. We should include this 4.4 also, right? In that.
Yes.
Good point. So I made a mistake there. So this will be 1. So this will go into a circular thing, right? How will you solve it? This will go into a circular loop, no, now, because if I increase this, the number of Friendly also will change. Anybody done this spreadsheet? Like solved it through and through? Do you understand what will happen? Like if I do this, okay. So currently, let's say per share price. So how do we go about it? So this 4.4 no is always a certain proportion of Cougar's investment, correct?
Yes.
4.4 is basically 22% of the total amount raised, right? So that will be a derivative of the Cougar's investment, right? Okay, so we'll have to basically say if Cougar is putting 15.5 or whatever, let's say this number will be Cougar's investment divided by 1 minus the ownership of Friendly Ventures into the ownership of Friendly Ventures. So this will be 4.37. Got it? This is the math everybody did, right? So I have this formula. I basically said that, okay, this is the proportion between the two investors. Because this guy, whatever Cougar does, this guy will do 22% of that in a way that, everybody else is diluting. So 22 by 78 is what he will do. Okay. Am I able to explain this or not?
It's clear for me. I don't know about the others.
Okay, good. Thank you. One person having clarity that I can run from here. Okay. So now our post money here should not be like this. It should be coming from a formula. Okay. So this should be 100 plus this total investment. Okay. This is how the math should work. This is still 13% because whatever the decimal somewhere. And the total is now 19.6. What will you do? If it is 19.6, and this guy is 50.1. So it's sort of meeting your criteria. What will you do? Will you push Cougar to take 19.6? Will they accept it?
I mean, yeah, why not? It's
They might.
small
Usually we've
change.
seen that 0.5% people are willing to give up. In prorata, if it is 4.4, you say ki boss, you invest $3 million, people may be willing to accept. Okay. So people may be willing to reduce on the friendly part. I think they will be happy. They will be okay to go down by 1% to 21%, even to 20. They'll probably want to hold on to 20, but they might be willing to let go of the last 2%. I feel. So you could reduce this 2%, and maybe that could be the stake that angels retain with themselves. Okay. So even if the angels don't sell all of it, you could still have a solution where friendly goes down to 20. Cougar is sort of 19.6. And particularly if Cougar goes down from 20 even a little bit, you have a strong argument to make to friendly also, right? And the founders can be at 50, 51 or 50.1 or whatever. Okay. The scenarios I would want to build, I will do the same exercise with 110 also, and try to get some more money in the company. I'll probably hold the percentages the same, okay, but try to make the pre-money higher. So what I would do is I'll make this 110 pre-money. 110, and in this mathematics then I'll probably do 110 here. Okay. And this number which should come from here. Okay. So this is too low. I'll probably increase this number to maybe 17 invested here. Yeah, and 4.8 from friendly. So 21.8. So with just 10 million increase, you got $2 million extra in the company. Okay, which is like 10% extra in the company as capital. That's what I would try to achieve. If the original target was to raise 25 million, you don't want to raise too less. Although in the original scenario, you would have raised even more because 5 million would have come from friendly and 25 from Cougar. So you would have raised 30. Instead of 30, you're raising 22 or so. Everybody there with me? You're still letting go of $8 million as secondary to angels. Okay. In this exercise, what do you want to discuss additional? I think we are done here. What else should we discuss?
So this is typically not a precise math, is what is coming out to me, right? Where it's very dependent on how
precise, yeah.
In the sense, it's never to the point saying
कि prorata
itna taka hai to itna hi lunga. It's going to be dependent on like your relation with the partners and stuff, right? How you play the people around.
It should not be that way. No, that's the leverage. That's what we're discussing actually. We're not discussing just the spreadsheet today, right? I mean, you found leverage in 3 places. You could increase the pre-money. You could reduce the absolute holding of Cougar. You could reduce the prorata. You could also play with the angel as secondary. There are three levers you have, three major levers.
Could a leverage, like for example, Google promising saying, okay, we'll set in place MSOP separately to allow you to claw back or buy back from us or something
that's
along
a
those
slippery slope, but yeah, that's also a possible thing. That's a fourth possibility, but it's a slippery slope.
Why is that typically not advised? From an investor perspective, it's bad, or for founders, it's bad?
Yeah, it's too early. This is pre-series A, that's why. That's all. Nothing else. This sort of becomes a habit for every investor, right? You know, like particularly a Cougar Ventures kind of a large fund who's doing a 25 million pre-series A, they will not be like keen to do anything like this first. They will want to just straight away, you take the money. They would not want to get into all the structuring, for sure.
Got it.
Okay, can we go to the fund exercise? How many of you were there in the first discussion about the fund exercise? Hello, how many of you were there?
I
in
was
the first exercise when we did the fund math.
I wasn't.
Okay, who else wasn't there?
I wasn't there either.
I wasn't there. So.
Okay, let's open exercise 1 here. Sorry, exercise 2, fund modeling, right? How many of you have applied your math to funds? And okay, let's solve the first question. How many unicorns does a $100 million fund need to aim return 5x of the money? Let's start. I want people to chip in. Typically, a $100 million fund, how much equity will you start with in a company, in each company?
Mid-teens,
Because if we don't talk,
perhaps?
it will not work. Huh?
15 to 20.
10 to 15%.
15, 20. Okay, let's pick a number. Starting equity for a $100 million fund.
17.5.
That's too high, boss. Too high. Let's pick 15%. Is that okay?
15. Yeah, 15 is good.
15. Okay, let's take 15% equity. Okay. So you have to return $500 million, right? Now, let's assume the number of companies you invest in from this $100 million fund is 25 companies. Is that a fair assumption? Or 30 companies?
I think larger. Some would, I presume, some would be in the
40
range
companies?
of 250. Yeah, I would say 35 to 40.
Okay, let's say 40 companies, right?
It would be wanna
So
also
this fund has 40 companies.
No,
Sorry?
but then don't you want to factor in for follow-on and stuff like
Yeah.
that?
So
Well, maybe they're writing a $1 million check, so they will have 40 million for the initial checks and 60 million for follow-on, let's say. Okay. And usme bhi, malab, it will not be 60 because 20 million will go into fees or 50 million will go into fees. So yeah,
तो आप
maybe
कौन से
another
स्टेज
50
में
million.
वो भी तो डिपेंड करेगा ना. तो if you are at a
Sorry?
seed of if so the assumption is this is like seed stage, is it?
It has to be assumption, no, because you're getting 15% equity buddy in a $100 million
Hmm.
fund. It has to be seed stage, right?
Yeah.
If they were writing Series B checks, we'll probably be assuming 2% equity, isn't it? So this is a seed stage fund. Yeah, you're right. So you are assuming 15% equity in around 40 companies, okay, and you have another maybe $50-60 million left, okay, for the next round. So you'll probably protect this equity only till Series A. After that, you'll max out. Fair enough. So if the company goes to a unicorn level, let's say Series D or Series E, what will be the equity left of this fund? Can somebody do the math for me quickly? So 15 will go to 15, will not go down in Series A because you protect it, right? Let's say you do pro rata. Series B, you don't have much money. So broadly, you will go down from 15 to 12%. Am I right? Series C, you will go down from 12 to maybe 9.5%. Am I right? I'm assuming 20% dilution in every round. And Series D, you will go down by another 20%. You'll probably go to 7.5%. Did I get it right, guys?
Yes.
Will the company be unicorn in Series D or will it not be a unicorn in Series D? एक और round चाहिए ना unicorn के लिए? नहीं चाहिए. Right now you don't need last 2-3 years, but earlier you will have to wait till Series E to become a unicorn usually. So let's assume one more round.
Yeah, let's assume.
Series E. Okay. So you go down Series A with less dilution, let's say. And you sort of go from 7.5 to let's say 6.5. Okay. So this company, this company is going to unicorn, has how much equity left? 6.5%. For a value of the company being $1 billion, right?
Yes.
So what is the amount of money that you get from that? $65 million from 1 billion?
Yes.
Math correct?
No, more than 1
money
million,
you need
because we probably allocated some in pro rata. So.
अरे वो कर लिया math यार, Vatsal. That's what we did. We didn't dilute from 15 to 12 in the Series A. We diluted only in Series B. हमने Series A में protect किया था हमारा pro rata. That's how we came to this number, 6.5.
Okay.
So we went down from seed to Series A, 15 to 15, then we went down in Series B to 12, then Series C to 9.5, Series D to 7.5, and Series E to 6.5. And 6.5 into 1 billion is $65 million, right? So you got $65 million from one unicorn. Everybody with me? How much money do we need to make total? $500 million, right? कितना पड़ा ना हमको total? 500 million. So how many unicorns do we need to have in this company? Let's say a unicorn is only $1 billion. How many such companies do we need to have? Anybody? 7, 8?
8, yeah.
7, let's say. Okay, approximately. Right, guys? With me? Everybody with me?
Yes.
Yeah.
Now it's possible that out of these 7, 1 or 2 unicorns will become probably 2 billion, 3 billion also, right? I mean, if it is 2021, it will become 5 billion also within the same year. But let's take a realistic assumption that 1 or 2 will become $2-3 billion also, right? So maybe you need 4 or 5 unicorns. Am I right?
Yes.
What are the chances now that a 40 company portfolio will have 4, 5, 6, 7 unicorns? कितना chance होता है? What are the chances? Like, have you seen any portfolio? Have you seen any portfolio which can do like 10% as unicorns from starting from seed stage?
I guess initialized cap fund one.
Plenty of funds have done it, was not impossible. Okay. In India, I have seen Lightspeed do it. Lightspeed 1 and 2, they both have 10% or more hit rate to unicorns. I suspect Sequoia has it, although they were not seed stage investors. Excel may not have, but they may not be very far. But they did do a lot of seed rounds at some point. So yeah, it's a tough one. But particularly for a newer fund, not a brand name fund, it'll be tough. Do you guys think Surge will have a 10% hit rate to unicorns? They have a $200 million fund, right? And they are doing, they're sort of doing from a $200 million fund, they're doing sort of 40 companies. What do you think? Like 10% of the companies will become unicorn? Is it a fair assumption or stretch target? 10-15% becoming unicorns?
Feels like a stretch.
Okay, so
Feels like to be honest.
Feels like a stretch, right? Like, I mean, if somebody told me that, like 1 out of every 6 companies I invest in is a unicorn, but if I was so good, I'll probably just do prop fund only. I will not do public money seriously. I'll borrow and I'll leverage if I'm so good. So it's a stretch target, right? Now, okay, somebody's asking this question, 2% even post-deployment. Yes, Varun. Bulk of the fees are constant, particularly for smaller funds, because they'll need costs throughout the fund. Broadly, you charge 2% on the committed capital for the first 4 years. After that, you reduce it a little bit by the amount of written off. But if the company is alive, you charge 2% on bulk of it. So typically, a 8-year duration fund or a 10-year duration fund will end up charging somewhere between 16 to 20% of the whole capital as fees. So out of 100, 16 million to 20 million will go into fund and fees and expenses. Some expenses like audit and legal fees, etc., also people charge beyond fees also. Some other expenses of like hosting a LP party and all of that are also charged to LP separately. So it ends up becoming 2.1, 2.2%. In India, there is also a GST if you are a domestic fund. So that's additional, okay, which I'm not calculating here. But yeah, so 15 to 20% is a safe assumption for fee and other expenses throughout the fund. So out of 100, you're investing only 80 million, by the way. Okay. So now let's go back to this. So I mean, how many you guys think that there will be a lot of 5x funds in the country?
Very few.
Very few.
Very few. Okay. How would you is given this, is this 50-50 ratio where 50% of the money goes into the first check of $1 million and 50% of the money goes into follow on? Is it a good ratio? Should it do like 30 company portfolio and do more follow on? How should you go about it?
So in my limited understanding, I think doing more bets is more important than doing follow-ons. It may
What is the downside? I agree. Doing more bets is more important because it will at least increase the chances of you getting a unicorn, right?
Exactly. So I think if we look at, I think doing 40 bets would be far more important because, essentially, otherwise you don't have that chance of, getting to that 6.5 either.
Okay. So now I'll tell you the negatives, right? What are the negatives? I understand. So you don't have a chance of getting 4 unicorns if you do only 30 companies. You're right. You still need 4 unicorns. The number is constant, right? I mean, we need $7 billion of market cap in the companies. You're right? So whether it is 4 unicorns or 5 or 7, you need that money. You're absolutely right, Rahul.
So I think we need a higher mean because I think median would typically be low.
Okay. What is the downside of doing 40 companies and not following on? Because here the chances are you do seed rounds, you probably do a pre-series A or a series A round, but series B mein you say ki boss mere paas to pureta nahi hai. I can't support. If somebody comes to you for a bridge round, you say ki boss, we are doing 40 companies, we don't have money to give you bridge. How will that play in the mind of the founders?
Not well. They would want people with deep pockets.
Not well, right? The people don't like this. Founder like, boss, ye kya yaar? Series B is like today's market. Series B is like practically like within 1.5 years, right? It's very early. So the founder will not be happy.
In all honesty, I think it'll depend on the, assuming it's a Series B and one is a seed investor, and it may have connotations to a brand per se, right? Like you said, like a little lesser known fund. If they are not participating in a Series B, I really doubt founders would have an issue versus maybe a tier 1 very popular fund not investing, because that may be more a signal issue than
that's the problem, right, Rahul? No, I agree with you. I understand, but everybody actually wants to be a tier 1 fund, no? Meaning that's where you want to position yourself. You want founder going in to think of you as a tier 1. I mean, frankly, I also got away. Recently, we won a deal from another fund, and I got away by saying we're a tier 1 fund. Founder didn't even blink his eye. Like, I slipped it in, and everybody accepted it. So, but that's okay. The other problem is typically how many partners will or investing hands will a tier 1 fund have? 1, 2? 3, usually 2, right? Maybe 1 or 2 associates. So there's like 3 or 4 people investing, but usually 2 people who are making decisions, right? So in a 3-year period, this guy is investing like 20 deals. 2 partners, let's say, in a $100 million fund, right? That will basically mean that this guy is making 7 decisions a year. That's a lot of number. Typically, if you look at successful funds, how many investments do they make? Like a Elevation or a Sequoia or an Excel. Everybody makes like 3-4 deals a year. That's all.
You mean per partner, right?
Per partner. Yeah. So these guys to do 40 deals, they'll have to do a lot of deals, man. The problem is that the moment you start doing 40 deals in a fund, you sort of, lose discretion. Meaning there has to be like, how many deals you can do is not just defined by the money you want to make and, how much you want to spread yourself. Right? That's one axis. But there has to be like, okay, what is a good number of deals to digest? What is a good deal flow that we have, and how many can we pick? How much do you want to filter? And what is a good discipline, good pace to sort of, think, keep saying no, maybe help the company a little bit, right? Also, you want to do slowly because you want to see the results of your previous investment, right? I mean, when I get money and I plonk money in 10 companies in 1 year, I don't really get to know how am I performing this year, right? Are the companies doing well or not? Are they getting next round of funding or not? Are the founders doing well or not? Are they able to hire people? All this feedback will not come if you invest every month. You don't have a breather in the middle, and you don't really have time to test your cohort. Okay, somebody has a comment here. Sahil Dingla saying, yeah, you're right, buddy. One company can become a decacorn. I agree.
Yeah.
So 3 big hits will be enough. We already brought this number 7 down to 4. You can make it 3. I'm okay. Right? It's fine. But one decacorn out of 40 is like even more tough. Okay. Because India was a decacorns. There are a very few number of genuine decacorns right now. I don't think some of the listed companies also deserve to be decacorns. Decacorn का limitation ये है कि a decacorn company 75,000 crore rupees in a steady state ought to do a profit of around 2,000 crore rupees. That's a lot of profit to churn out in India, to really deserve that market cap in public markets. But yeah, you're right. I mean, if there is a decent amount of bubble going on, you could your $1 billion company could go to $10 billion in a span of 2 years. Possible. We've seen that something like this happen this year also.
Yeah.
Okay. Smaller AUM fund should be easier to do a 5x by this logic. It may make more sense to do a smaller size fund, which is contrary to what we're witnessing more fundraising larger. Yeah, you're right. See, everybody wants to basically say, if I have a company, and typically what a fund does is people raise a $250, $300 million fund, sometimes even $400 million fund. They will still write a $1-2 million check. They will do 40 companies. So the initial checks might be just 80 million or 100 million only, right? The first 40 checks. And the remaining $300 million will go into follow-on. That's what the typical playbook is. So it's typically 30 in the first check, 70 in the follow-on checks, usually. And that gives them their positioning as a tier 1 fund. We are always pro rata, we are always investing, blah, blah, blah. Also, people are not necessarily aiming for a 5x in India, because like $400 million fund ka 5x will be $2 billion. Ownership will still be like single digit by the time the company is exiting. So single digit ownership mein, if you want to churn out $2 billion for your own investors, the market cap of all your portfolio companies should be more than $20 billion, right? 10 times more if you have 10% equity at the time of exit. $20 billion market cap generated by one fund is a lot. Again, some funds have done it. I'd say Sequoia, Excel, Lightspeed, SAF earlier cohorts also, but very tough to generate 20 billion market cap in one fund, right? That'll be tough there. Yeah. So smaller fund, Varun, the problem of smaller fund, and we've done smaller funds, right? I mean, like for me, my fund which had share chat is like double-digit returns already. We're not even doing 15x. We are playing in the region ki 15x hoga ya 20 hoga. I'm already at 12x right now. But But a very small fund again has multiple other problems. One, founders don't want to work with you because you can't give enough money. If a returning founder comes to me, my own portfolio founder wants ask me for $2 million, which is a fair ask, right? I mean, the guy is just asking for a little bit of extra money. I can't give. If I have a $50 million fund, I'll have to partner with somebody, all that. I won't be able to pro rata. And if you're in fund 4, you are a reasonably well-known brand name, you don't want to do pro rata in series B also, it is a negative signal to the founder and to any other investor. So yeah, what we've also seen, guys, is I'll just do an interesting take. Okay. Particularly this happened in our fund 2. It may happen in fund 3 also. We said, what is the multiple on our first check? Okay. And what is the multiple on our follow-on money? Okay. So in my fund 2, our first check and follow-on ka multiple both were similar because the mortality was very high in the first check. Okay, we had like 3 winners out of 20 companies, 3 or 4 winners only out of 20 companies, and the winners we put some money in follow-on. We should have put more, but that multiple was comparable. So if you are not blindly putting pro rata in every company, right? If you are sort of able to pick some of the better ones, it's very tough to do. If you are, you probably have a shot at like not diluting your multiple too much from just doing seed only, right? I mean, so that's the other nuance here. It's a very tough one to do. We are trying to do something like that where we sometimes we're not very comfortable with say, we'll skip. In some situations, we have skipped one round and then come back again also. Not skip entirely. Skipping entirely is ruled out in this market. I mean, it's not good for the founder also. You have to put $500,000, 1 million, even in a series B. Even if you want to skip, that's like putting a small check, right? But you can always come back again. Okay. Anybody else has comments on this?
No, completely agree. I think selective pro rata may make a lot of sense, at least from the economic side of things. Definitely harder to
harder
choose
to
from a
execute.
signal point of
Harder to execute, harder to choose from a signal. Harder to even judge also. Frankly, you don't know your winners in series B. It's too early. Okay. It's not like nowadays series Bs are just 2 years old, right? It's very difficult to judge if the company is a winner or not. Okay. Anybody wants to do the math on how much will the partners make if the $100 million fund actually reaches $500 million? Anybody? Quickly. Varun, Ashita.
80 million
Sahil,
between all of them, roughly.
80 million. So 40 million, 400 million is the gain.
20% carry.
20% is the carry on the gain. The profit is 400 million. That's 80 million. Now, typically, there is a bonus carry also in smaller funds, right? How much would Sequoia make, by the way? Anybody knows the Sequoia carry?
30, I think it's 330.
30%. Bulk of the good funds, top tier funds are 30% carry right now, right? So those guys will be making $120 million on this. Okay.
Is it on slabs or like greater than 3x, 30%?
No. Tier 1 fund are 30% on practically all the gains, as long as a 6% hurdle is met or something like that. The hurdle is also pretty low.
6%?
On the entire gains is met.
Hurdle rate.
Minimum hurdle, right? A fund like ours, we typically charge 20% on the money till 3x, and anything above 3x, we charge 30%. So we'll probably make 40 and 60, $100 million in this, if this happened.
Is that a fractional carry or is it a absolute carry? In the sense
extra bonus carry.
Okay.
Yeah, so typically, it'll only be on the incremental. Typically, any bonus carry will be on the extra return you make beyond a certain threshold.
Got it.
But yeah, I mean, most funds of small size are keeping a bonus carry nowadays. Okay. How much money will the partners make in fees? Anybody wants to do the math?
What's the tenure of the fund? 10 years, 2%, 20.
10 years, which are $15 million of fees, let's say. $16 million of fees. How much money will they make? My basic math is that half of the money is spent on the team, rent, travel, etc. In some cases, also in distribution fees for fundraising, etc., etc. And 40-50% is what the partners make typically over the life of the fund. So in this case, over a 10-year period, the partners will make about $7-8 million in fees. But they will have another fund starting in 3 years, right? A new fund will happen. So partners can make $7 million in fees out of a $100 million fund. Fees are like as their own pre-tax income, which will include a salary also usually. But what is the carry if the fund is doubled? It will still be $20 million carry, right? You just simply double the fund. You will still be above the hurdle. You will still take a $20 million carry, right? So while there is a lot of noise about people making money from fees, okay, a lot of noise. I mean, a lot of people have been talking about this, and a lot of literature is there. Frankly, this thing about fees being very important to fund managers is not necessarily true. Okay? It's like founders also. Somebody takes a secondary. You don't say here now the founder doesn't have an incentive, right? When the founder has sold 1% of his equity, taken $10 million out, but he's still looking forward to $100 million in the future, right? or $200 million in the future. So I think that's the other perspective. Of course, in a $500 million fund, your at a partner level, you could make like a couple of $1 million or $2-3 million. If you have multiple funds running, you could probably be making $5-7 million a year as income. And to that extent, you don't, your rewards are not back-ended, right? Your rewards are start from day one, from the day of raising money itself, right? I mean, it's not linked to like a smaller fund typically will get a sizable pot of money only after 10 years or 8 years. Okay, the concept of catch up. Now, there is a hurdle rate. Typically, it's 8%. In some big funds, it's 6%. So if you return the fund only 1.5 times, right, and the compounded CAGR of the fund is only 8%, you barely meet the hurdle. In this case, you will not take any carry. Okay. But let's say you got lucky, you returned $1.5 million. Some dead stock was there in the portfolio, which goes to give you another $20 million in this, okay, or another 20%. So 1.5 goes to 1.7, right? Now you have returned so far all the money to the LPs only, right? From 1.7, what will be your carry? 0.7 is the profit, and you will take 0.14. Am I right? Everybody there with me?
Right.
Yeah.
Anybody is confused with this?
Yeah, if there's a hurdle, then we don't get any carry, right?
No, you don't get carry till the hurdle, right? But from the incremental $20 million, right, you return 150 out of 100 million ka fund. Extra 20 million that you got from the last company, okay, this 20 million will be split by first 14 million will be given to the fund manager, and 6 million will go back to the investors. So because you were catching up on the carry for so far. So far you met the hurdle, but anything extra beyond the hurdle goes to the manager straight away. So first the hurdle is met till 1.5, 150 million, and then incrementally it will go to the manager, and then if something is left over, will be split into a ratio of 80-20. That's the concept of catch up. So first you give the principal back, then you meet the hurdle. After the hurdle, there is a catch up for the fund manager because he's met the hurdle. And then whatever is beyond these two things, catch up and hurdle both, you split in the ratio of 80-20. That's the concept of carry. Anybody wants to do some scenarios and make a spreadsheet, send it to us, take a look and make comments on it, right? If you want to sort of, say $100 million fund became $170 million, $200 million, $300 million, what is the carry? How many unicorns will you have? Will you need? You want to build all the scenarios. What is the return to the LP? You can also do the maths on, what is the IRR of the fund? How will you find that out? IRR on the fund? If you have to model it, how will you model? So what you do is a typical $100 million fund, you assume it's being deployed over 3 years. Okay. So 33 is the outflow in your cash flow chart. And you assume that your exits are happening in year 7, 8, 9, or maybe 10, or let's say 7, 8, 9. And the money comes back 50 million in year 7, 50 million in year 8, 50 million in year 9, 100 million in year 10, whatever distribution you want to do. and then you do a IRR on this mathematics, right? This is the like modeling perspective, okay? And then you can compare on what is the money returned after carry and before carry, and do an IRR on that basis also. You can get a net IRR and a full IRR. Anybody has done something like this? Any mathematics anybody has done? Anyone? No. Okay. Anybody has seen a sheet of calculating things like TVPI? Anybody knows what is TVPI? Yeah, Aman, closes are basically what do you call, you do a fund close where you say I'm raising $100 million, but if I raise 50, okay, I will do a close, I will start drawing down till I reach $50 million. I will not draw down. Yeah, so closes will affect IRR, but when you're modeling, you can make a safe assumption, right? I mean, when you eventually after 10 years, you'll have the real data of when the money came in. You can do an IRR on actuals, but for modeling, you can assume that money is equally split between 3 years, and then do your modeling. So what I'll request is Shruti has done some mathematics on our past returns, and then we've calculated something called TVPI, total value per invested, net IRR, gross IRR, how much money is going to carry, how much money is going to investors, blah, 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 right? We'll see if we can hide the real numbers and share the sheet with you, and probably we can have another discussion on that sheet.
Actually, I've done some rough workings on this exercise. Maybe I can circulate that with the gross and net.
Sure. This one also, and if you can calculate TVPI and net IRR and all that also. Right?
Sure.
You've done some of that work already.
Yeah.
So we can share.
TVPI will be different from MOIC?
Yes, absolutely. So we have math for that also. You're right. MOIC is only money multiple on the invested capital.
Right.
And TVPI is the multiple on the entire committed capital. Absolutely.
Are we taking in the time thing as well, or both doesn't have that? MOIC method, it is just
TVPI and MOIC don't have time incorporated. IRR will have.
IRR will have. Got it.
Right. Gross IRR will correspond to MOIC, and net IRR will correspond to TVPI and DPI.
Got it.
Varun, while calculating IRR, yeah, potential write-off, when you do 5x of the fund, I'm saying 5x is the cash return. So write-offs and all are blended in. You just need to see from an LP perspective. When did they give money to you? When did they get money back from you? That's how you'll do the math. 1%, 1.5% write-off per year. I am not aware. I don't know. Can you elaborate? What have you seen, Varun? Varun is not here, I think. Okay.
No, I am here. Sorry.
Yes,
Varun,
what are you saying?
I'm actually in a busy place. So, I spoke with the fund manager, and they were not. So in their fund modeling, what they were doing was of the AUM or the fund size, they were accounting for a 1.5% potential write-off per year, and so that they're building it in their calculations, and it is not whenever it happens. So that was something that they were doing.
I don't see the need of it. You look at the model Shruti is prepared, right? Take a look at it. I'll tell you what, genuinely speaking, it'll be good for all of you to give it a shot as to how does a VC fund evolve? How do you invest money in every year? When will you invest follow-on money, right? And maybe the first year, the outflow is not 33% because, first year you'll only be writing the initial check. You'll not be doing follow-ons, right? So maybe you'll write 10, 12 checks in the first year, and your outflow will be only $10, $12 million, right? In the first year, maybe some more fees. So maybe the heavy investment will go in the third year only because, a lot of follow-ons, a lot of Series A and B will happen in the third or fourth year, right? So you can do a modeling of how the cash flow will happen from LP perspective. When will the return happen, right? You'll probably take a part exit in Series D, then take a full exit in Series E, and then do your IRR and TVPI on that basis, right? But what I'm broadly want to explain to you is that, to return 5x is a lot of heavy lifting there, right? So it's not very easy to make a fund 5x, even if it's a small fund. It's a very complex and very difficult thing. Right? But you should do a modeling yourself because you guys are all working in VC funds, but it's important to have a context of what's happening around you, right? I mean, what system are you a part of? But anybody makes a sheet, happy to look at it and give comments. Okay. Bye guys. Thank you very much.
Thanks,
Have a great,
Anand. Super
you,
cool.
Anand.
Thanks,
Thank you.
Anand.
And, enjoy yourself.
Thanks so much.
Amazing.
Thanks, Anand.
Yeah.
Bye.
Yeah.
So much.